Greetings, members, one and all of the Salivation Nation. We've been going for quite a while now, over 10 years without a recession. What gives? We'll explore that and why it may not be so good for the economy in this video. Yes, this topic was sent to me by a man with no name. Yes, indeed. And this is about the economy and recessions and why, most of us would be normally happy that there's not a recession. It typically happens between once every 8, 9, 10 years, and we've surpassed that now. We're going to explore an article here from Market Watch as to why long periods of going between recessions may be bad for the economy, and how Deutsche Bank has aggressive anti-recession steps pose big risk and could lead to more crisis. This comes to us from Market Watch, was shared with me by no name. We can look and see here about the U.S. business expansion length by month since 1854. This is a very interesting chart here by Deutsche Bank. Shows the average U.S. business expansion length. Look at that. Super cycle era from March 1991. It goes, almost 140 months, 120 months there. And look at the very interesting indeed. But in June 2009, look at how much it's a beat. It's right there at the same level of the super cycle era. The 10-year-old economic expansion will set a record next month by becoming the longest ever. Typically great news, right, but not by strategists at Deutsche Bank, which, by the way, Deutsche Bank is in trouble too. Prolonged expansions have become the norm since the early 1970s, when the tight link between the dollar and gold was broken. The last 4 expansions are among the 6 longest in U.S. history. Why so? Well, freed from the constraints of gold-backed currency, governments and central banks have grown far more aggressive in combating downturns. They've boosted spending, slashed interest rates, or taken other unorthodox steps to stimulate the economy. However, there has been a cost, contended Jim Reed and Craig Nichol of the global investment bank Deutsche Bank. The policy flexibility and longer business cycle era has led to higher structural budget deficits, higher private sector and government debt, lower and lower interest rates, negative real yields, inflated financial asset valuations, much lower defaults, ultra-cheap funding, less creative destruction, and a financial system that is prone to crisis, they wrote in a lengthy report. In fact, we've created an environment where recessions are a global systemic risk. As such, the authorities have become even more encouraged to prevent them, which could lead to skewed preferences in policy making, they said. So we think cycles continue to be extended at a cost of increasing debt, more money printing, and increasing financial market instability. Even the current economy recovery is not all that it seems, Reed and Nichol said. It has been the weakest of the 11 expansions that have taken place since 1949. Yet despite the weak growth, stocks and other assets have had one of the strongest runs ever. This could hint at the extraordinary lengths global authorities have gone to ensure this recovery continued, they wrote. Liquidity and intervention has been enormous, and this has flowed into assets. The silver lining, sort of, Reed and Nichol don't see danger right over the horizon. I tend to agree with them on that. They say the situation can go until the current era of low inflation gives way to rising prices, or leading countries like the U.S. run into a debt funding crisis. It could be several years or even much longer before it happens. But I will say, notwithstanding that there's been a lot of things, especially in the 2007-2008 crisis, that things were snowballing so quick, it was at a near crisis mode situation, where if they didn't take action quickly with something, then it could have really gone into a deep depression The cards were falling around them pretty quickly there. One could make a compelling argument that regular recessions strengthened the economic success story as they acted as natural cleansing mechanism, ensuring an efficient allocation of resources and preventing the cumulative buildup of inefficiencies that could have arisen without regular downturns, Reed and Nicole wrote. And I will say that, with the things that have occurred, especially look where we're at now in the economy, we're still kind of riding the stimulus that occurred with the quantitative easing. We've not really seen from that stimulus much consequences of it. So the bubbles and everything that were in place before have not really gone away, so to speak. I mean, there's been some downturns in the stock market, but so we may be seeing some real economic growth, but it's on top of an inflated artificial bubble. And so one of those bubbles is going to pop, and it's probably going to be the one that's underneath, which means that the real economic progress that we've seen will just collapse in on it. People will lose faith and everything. A lot of that has to do with the money, the M2 money supply, the increase thereof, and there's talk of a fourth round of quantitative easing to do it. I think that will be absolutely the wrong move to make. And because people are going to lose faith in the currency. Already other nations around the world are trying to extend their way to separate themselves as much as they can from the dollar. And I think that's why Russia, China, and other nations are trying to increase their holdings of gold. And you look back here in this article, it's abundantly clear how it's we're not tied. There's no constraints. We can do whatever we want. The Federal Reserve can do what they want, and as they've seen now, they're playing a very cautious role. They've done nothing today with regards to interest rates, but it is in the wheelhouse for the future, and more than likely, all indications are that we will see some downturn. Of course, with trade being the trade war continuing to go on with China, there's been some somewhat positive news, but we've heard positive news before in that front. Until we actually see a deal come forward, something that's codified, and even the USMCA, though there's been agreements there, the legislators have got to agree on it. And actually, though I probably have more faith in the Canadian and Mexican legislatures than I do our own here in the United States. So there's a lot of things out there. There's a lot of uncertainty out there. The certainty of the free market system here in the United States and business and real job creation and job growth is encouraging, but it's still delicate. And so we'll see how this all plays out. Then you have things like Deutsche Bank here that is being quoted from analysts from within those banks. I'm glad they're talking highly about gold, but the banking institutions here, there's a lot going on. Cryptocurrencies, there's a lot of different factors that come into play with all this just to see where this all lays out. But the fact that I do agree with the sentiment of the article here, the longer time between recessions, I think, could be bad because the cleansing mechanism of a recession and how they handle it, I believe how they handled it the last time was the exact wrong way to go. I believe you really have to have faith in a free market system, and I do believe you need constraints. A rules-based monetary system is something that's long overdue. We're going to be forced into it one way or the other. It just means that we have more time to kick the can down the road. And make no mistake, these big government policies and this printing of money and the things that have been occurred, the stimulus, the spending, those are just quick fixes that are essentially just kicking the can down the road and creating other problems on top of the already existing ones, and for our children and grandchildren to adhere or to have to deal with. The debt of this nation, it's just a number, $23 trillion. It's just a number, they say. Sooner or later, somebody's going to pay the piper on that. And I believe that piper will come in the form of a dollar reset and a revaluation of that debt. And we shouldn't have to get to that point, in my view. We need to be responsible with the money that we spend privately as individuals. The dollar we spend today is not the same dollar that we spent 2 years ago. It's losing its value, which is why we hold gold and silver to protect ourselves in times like these of economic instability. And it's going to be long holding because there's a lot pushing against gold and silver right now with economic progress and the like. And there's a lot of natural market forces at play, but there's also some manipulation. I think that some of that manipulation occurred during that recessionary period and the response to it. So hold fast, hold true, and hang on, and we will continue to do what we do by holding gold and silver as we can. I would like to extend a multitude of gratitude to you all for watching, and thanks again to No Name for this interesting article here. I would like to encourage you all to please rate, share, comment, and subscribe.